Welcome to the Punk Capitalist channel, where grown-up punks say F the world but are matured enough to know that we want to be wealthy so we can shout it even louder. One of my best friends was a perpetual troublemaker. He got in trouble with teachers, got expelled from school, went to juvie, and spent some time in prison. I've often told him he should write the book, 100 Ways to Get Caught. While being maybe 40% the rascal he was, I have generally avoided any kind of legal troubles. While I did not know it at the time, I incorporated a margin of safety to avoid trouble. Risk is everywhere. It is wise to know where you can get in trouble and learn to either avoid it completely or be well compensated for the risk. In this video, we will cover how iconoclastic investors mitigate risk. We will move across the spectrum of value from buying assets to earnings and growth. But before that, please like and subscribe. The original idea of value investing, also known as punk capitalism here, was born out of the traumatic experience of loss from the Great Depression. The granddaddy of value investing had these two simple and pretty obvious ideas. While the ideas are obvious and simple, it is not practiced by most. The old fart said, "It is extraordinary to me that the idea of buying dollar bills for 40 cents takes immediately with people, or it does not take at all. It's like an inoculation. If it doesn't grab the person right away, I find that you can talk to him for years and show him records, and it doesn't make any difference." Let's look at the first idea. Invest with a margin of safety. In another video, we will look at how stock market fluctuations increase and decrease the margin of safety. This channel aims to go from A to Z with no original ideas and armed only with the ideas of iconoclastic legendary investors. Please smash the like and subscribe buttons to continue this journey with us. Every punk's character, temperament, and experiences are different. We all come from different families, cultures, and cities. If you look across the portfolios of successful investors who have survived decades, all their portfolios will look very different. Some punks are extremely diversified, while others make concentrated bets. Some buy mediocre companies at wonderful prices, and some buy wonderful companies at reasonable prices. Some invest in real estate, some in debt instruments, and some buy businesses in whole or in part through the stock market. Where they converge is their demand for a margin of safety in their bets. The idea that they are getting more than what they pay for. That difference between price and value is the margin of safety. The simplest form where a margin of safety can be gained is through the balance sheet of a company. Here there is less need for superior insight on the economics of the business, just a good assessment on the value of the company's assets and liabilities. There are times when a company is selling for less than liquidation value. The most conservative measure of liquidation value is current assets like cash, inventory, and receivables minus all liabilities. To be even more conservative, inventory can be discounted if it is believed that some of it might be obsolete. Receivables can be discounted too to account for bad debt. Some analysis and common sense is required here. One example of this is Jadison Enterprise, listed on the Singapore stock market. Jadison was selling for $14.5 million. And its liquidation value was $31 million and had almost $19 million in cash. It was loss-making in the preceding years and turned a small profit at the time of this punk's purchase. After 2 years of increasing profit, the market value of Jadison increased to a high of about $87 million. A six-bagger if I had managed to sell at the top. For this strategy, I believe that punks need to install a margin of safety in their selling too, and start selling on a scale as the price reaches closer and closer to what the punk thinks the value is. I exited the position fully, close to the book value of $60 million. Currently, Jadison is selling for $4.3 million with liquidation value of $3.5 million. It hemorrhaged cash when COVID lockdowns hit the company. As we can see, Jadison is a lousy company, but its price offered a big enough margin of safety and outsized returns. There was a certain amount of luck involved in this fortunate instance. Not all will turn out positive, so we will need a diversified portfolio if our strategy is to buy lousy but absurdly cheap companies. As the Wrinkly punk said, if you buy things cheap enough, something good will happen. As we move up the scale, we can look at companies selling at a discount to book value with decent cash flow and with little or no debt. These companies tend to be neglected by the market because they are in boring or in low-growth industries. This reminds me of HTL International, a furniture manufacturer and retailer. The company was selling for $102 million when I purchased it. This was close to liquidation value, which offered a margin of safety. The book value was $163 million. The company's price was depressed in part due to poor accounting profits due to large provisions for warranties. HTL, however, had strong cash flows that yielded about 30% on my purchase price. The company was later bought over by another Chinese manufacturer for $400 million. The purchase price of $400 million can be taken as the true private market value of the company. This story leads to another way. Low-risk, high-return bets can be made. Something called special situations by Granddaddy Punk. The Chinese company offered $1 for each share, but the shares traded between 65 cents to 85 cents for the next 6 months after the offer was made. If you believed that the deal would have gone through after careful analysis, you could have made a 50% return in 13 months. Another example of a special situation was when Singapore Airlines bought over Tiger Air. Tiger was to be taken over at 45 cents a share. This punk bought in at 41 cents a share. It was highly likely in my mind that the deal would have gone through. This trade was done in 5 months with an annualized return of 23%, with seemingly low risk. Please like and subscribe if you want to be a punk capitalist too. A punk can also buy higher quality businesses that are selling close to book value. Book value can often be used as an indication of how much it would cost if you were to start the business from scratch. But book value does not show the economics of the business, brand power, distribution and sales channels, reach of customers and beyond. If we assume that a business has nothing special about it and can be easily replicated, then buying at book value offers no margin of safety. An example of this might be taking over a cafe at the depreciated cost of all of their fixtures and fittings. There is no reference of revenue or profitability. However, if a business is able to earn a return higher than what is normally expected, then buying at book value may prove profitable. A high sustainable return on invested capital suggests that there is something intrinsically better about this business and might be in fact worth more than book value. The Hourglass, a luxury watch retailer, is one such company. Hourglass's adjusted return on assets is 32% compared to 26% for its closest competitor. Hourglass also commands both higher gross margins and net margins than its competitor. At its highest valuation, the market valued this company 2 times book value. Currently, the stock is trading just slightly over book value and pays a 5% dividend. There is ample margin of safety in this punk's opinion, and fortunately the company is buying back its shares. To further illustrate the margin of safety principle, this punk invested when the shares were trading at 75% of book value after dividends was reduced due to COVID uncertainty. This punk was protected on the downside through high-quality inventory, cash in the bank, and investment properties. Due to their high levels of cash, low overhead costs, and low debt levels, any downside was unlikely to hurt the company substantially. Also, at that time, the secondary watch market was going bananas and every Tom, Dick, and Harry was trying to get their hands on a luxury watch. There were months-long waiting lists to get popular models. There seemed to be a disconnect between the stock price and reality. This mispricing allows me to now enjoy a 12% dividend yield and significant price appreciation. Contrary to popular belief, low risk equals high returns. Or to say it another way, the larger the margin of safety, the lower the risk, and the higher the returns. As we move up the ladder and away from book value to a more sophisticated view on margin of safety, we have to employ the thoughts and insights of the old fart and his partner the goat. The old fart finds his margin of safety not only from quantitative factors like profit margins and return on invested capital, but also qualitative factors. Qualitative factors are characteristics like durable competitive advantage, brand or franchise value, and skill and honesty of management. These factors are especially important if you intend to hold your assets for a long time and are not looking to make a quick profit. Qualitative factors provide a margin of safety when the company has to ride out different economic cycles and consumer trends. Although it may at times looks like the good times will go on forever, or at other times there is no light at the end of the tunnel when bad times hit. Remember that markets move in cycles. Good becomes bad and bad becomes good. Remember the saying by Granddaddy Punk that boils down the history of mortal affairs: this too shall pass. Qualitative factors, when assessed correctly, will most importantly allow the company to survive any major blow that life throws its way. Think of the Coca-Cola brand. It is close to impossible to overtake Coke as the leader in soft drinks, even if you throw in billions into marketing, distribution, and product development. Coke serves 2.1 billion servings a day in over 200 countries. While Coke does not win Pepsi in blind taste test, it does have a favorable impression in the consumer's mind. This brand has share of mind. The economics of the business also gives it pricing power. Due to the sheer volume of Coke sold, a 1/10 of cent increase in price per serve will increase the profits of Coke by $2.1 million a day, or $766 million a year. Would people stop drinking Coke if Coke raised its prices by 1 cent and earned an extra $7.7 billion? Coke has also survived and thrived despite past strategic business mistakes such as losing half its trademark giving perpetual rights to some bottlers at fixed syrup prices and introducing new Coke, which greatly threatened the company. The old fart said that I try to invest in businesses that are so wonderful that even an idiot could run it, because sooner or later one will. The qualitative factors are the most difficult to have superior insight because it requires a business-minded approach to assess the competitive landscape and a need to look into the future of that business. Some businesses have futures that are clearer than others. If we are demanding our margin of safety from qualitative factors, then it is wise to avoid businesses where its competitiveness 10 years down the road is unclear. I will end with another quote from the old fart. I am a better investor because I am a businessman, and I am a better businessman because I'm an investor. Please comment below if there are topics you will like me to cover. Please like, share, and subscribe.